You're listening to Lender Lounge with Kevin Kim, a podcast dedicated to helping our listeners in the private lending industry grow, improve, and streamline their business. I'm Kevin Kim, partner at Fortra Law, the nation's largest private lending law firm. Join me as we chat with the best and brightest in private lending. They're eager to share their years of wisdom and best practices for lenders, brokers, borrowers, investors, and more. Subscribe to Lender Lounge on your favorite podcast platform and visit our website, fortralaw.com, to learn more about how we can help you scale. Check out the episode summary below for other valuable resources. Hey guys, welcome to another episode of Lender Lounge with yours truly, Kevin Kim. Today, we are graced by the presence of a friend to the firm, someone I worked with for some time now, Wes Carpenter, managing partner. I got it right, title right, managing partner over at Stormfield Capital, a firm that I very much respect and a very much of a standout on the East Coast. So Wes, please introduce yourself to the audience and give us a little bit of background, and let's get started.
Yeah, thanks, Kevin. First off, thank you for having me and appreciate the kind words about Stormfield. Very briefly, co-founded Stormfield in 2015. Stormfield is an SEC registered investment advisor. We currently manage $750 million on behalf of, venerable institutions like endowments, foundations, wealth management firms, etc. But what we do, hopefully topical for today's conversation, is we originate first mortgage bridge loans. So that's everything from RTLs up to about $20 to $30 million commercial bridge loans. So we do cover kind of that gamut, which is a little bit unique. We're a team of 22 professionals operating out of an office in Connecticut. And again, I've been investing in this asset class since 2010. And again, Stormfield, as constituted today, actively started investing in 2015.
And you guys are a little bit different than a lot of the debt funds out there in the space, a lot of the private lenders out there in the space, in a lot of different ways. I mean, you do both CRE and residential, but before we get into that stuff, you guys first came onto the scene as an advisor. You weren't a fund first. You weren't a lender first. You were an advisor first?
No, we were always a lender. So
lender first.
We were a lender kind of from day one. Interestingly, right, we were never, like many of the market participants today, we were never brokers. We were never advisors. My background personally was actually as a multifamily investor. So that's kind of how I cut my teeth in real estate and asset management. It was on the equity side. My business partner, Tim Jackson, he was an institutional asset allocator. So he came from, the true kind of Wall Street, side of the business. But no, we are, I think that's kind of one of the things about Stormfield that makes us unique is, we are investors first.
Right.
We believe that the loans that we, find and underwrite and originate are extremely valuable. And, we never want to sell those loans. So, we recently just celebrated, $2 billion of loans funded. But I think what makes that a little bit different from some other firms who might hit that milestone is, those loans were funded on our balance sheet and will be held to maturity on our balance sheet on behalf of our investors.
Still, and especially in the RTL sector, now relatively rare fund strategy now, right? And I'd like to kind of get into the first iterations of Stormfield now 10 years ago. Wow, you guys have been around 10 years now.
Yeah. We're getting old.
Yeah, it's great. I mean, did you guys start out outright to the market as just direct lender with a fund, or did you guys start out more co-lender or just self-funding? What was the first kind of genesis of the company?
Yeah, 2011 through 15 was hung a shingle, started finding some interesting deals. The first handful of deals, I funded myself. That's ultimately how I met my business partner, Tim Jackson, is, I was effectively syndicating loans, right? Hard money loans, private loans, call them what you will. And over time, 2012 to kind of 2015, syndicating these loans across high net worth investors, developed a track record. You start getting kind of word of mouth. You did deliver on a loan for an investor, and they're going to tell their buddy that, at the time we're lending at 13-3, 14-4. It was a great time to be a lender. And ultimately, it got to the point where, I think on the personal side, I was making more money doing deals than I was at my day job. At the time, I was working as a management consultant. And so, at about the age of, probably 29 or 30, decided to have a full go at it. And that was 2015. Now, getting our first fund off the ground, right? Like we had great aspirations. It ended up taking a year and a half before we got our first fund off the ground, right? Even though we had a track record that went back, kind of 5 years, it was thin, right? It was probably a 5-year track record, but maybe only $12 or $15 million of loans originated. But getting that fund off the ground, right? Answering all the questions. Is an open-ended or a closed-ended fund? What are the fees going to be? Do you do a sub-REIT, et cetera, et cetera, et cetera? Had to answer all those questions. And finally, it was October 2016, we got our first, fund off the ground, which is the Stormfield Real Estate Income Fund, which is our flagship, and, track record kind of speaks for itself at this point.
So in that transitionary period, were you still doing like basically syndicating loans to get the deals done?
Yeah, exactly. Yep.
Yeah, makes sense.
That was kind of 2011 all the way through. We launched the first fund in October 2016.
Right, and it's clunky, right? And that can be a little bit painful for a sponsor to have to manage all those different people, all those different transactions. Let me ask you, like, was there a particular moment for you guys that, okay, we have to go direct and be a balance sheet lender? Like, was there a moment that made you realize that, or is it just like you knew you were going to do it out the gate?
I think it was a confluence of things. Right. First and foremost, there was the issue that maybe taking a step back, right? Everyone who doesn't have a fund, I feel like wants a fund, right? The problem with a fund is that, right, the cash drag, once you have a fund, the cash drag becomes your liability, right? When you're syndicating, right, loan pays off, you give that money back to your investor and they can sit on the cash and deal with the cash drag. But when you're operating a fund, particularly an open-ended fund, that becomes your responsibility. Now, the other side of that ultimately is, we'd gotten to the point where we had, probably a few dozen investors who would, this is again back before the fund, few dozen investors who maybe invested in 4 or 5 loans with Stormfield. One of those loans goes bad, and by bad just means it goes into default. The cash flow turns off. There's no impairment of principal. It's just that, right, the cash flow turns off. When that happens to 1 out of 4 or 1 out of 5 loans, right, the investor's investment in that asset class, its character changes, right? And we ultimately believe that, right, diversification is one of the only free lunches in investing. And so I ultimately think it was 2 things. One, we wanted to build the best product we could for our end investors, right? And that meant a diversified portfolio of loans where there's no concentrated exposure to any one position. And then the other side of that, quite frankly, is, if we think about our LPs, our investors, as our number one client, everything we do is for them, right? Protecting their principal, generating an attractive risk-adjusted return for them. Our second client, quite frankly, is our borrower. And, right, as anyone who's, operated in the market syndicating loans, right, you can't deliver on that promise of speed of execution, surety of execution, if there's ultimately syndication risk in the background, right? So, we wanted to build the best client or product for our clients, our investors, limited partners, and then secondarily, we wanted to make sure we can deliver on our promise to our second client, right, our borrowers, to provide them with the best product that we possibly could.
Being a true balance sheet lender gives you that, I guess you can call it, accelerated speed to close. What is interesting, the genesis for you guys was kind of when the market started to see a lot of institutionalization. You started to see a trend away from the fund strategy, the balance sheet lender strategy, the direct lender strategy. You started seeing a head turn towards what I would call correspondent lending. A lot of guys are table funding. What was it? Not your speed? Was it not something you wanted to pursue? Because I'm guessing the options were open for you. Because you're also on the East Coast, and a lot of those guys are based on the East Coast, right? Those programs are all on the East Coast. So, like, what was the reason not to get involved with those guys? Because I mean, you can do more deals, right?
Yeah.
I mean,
Yeah, I mean, look, I think it comes down to, a few things. One is, right, this philosophy of or just a notion of controlling our own destiny, right? As an entrepreneur, as a business owner, right? That's kind of why you set out on your own, is because you want to kind of control your own destiny. And right, what you realize is if you partner with, whether it's a correspondent or whether, a JV, right, you have a binary outcome, right? The wins can be big, right? If you sign up a good JV and, can allow you to produce as much as you want to produce, you have investor concentration, you have customer concentration, right? Think about any kind of private equity firm when they're looking at buying a company, right? What's the customer look like? And is there any customer concentration?
yeah,
If I have 90% of my dollars coming from one investor and that investor turns sour on the asset class, finds something that's more interesting, et cetera, my business blows up, right? And it's not just the business blowing up, it's right. The people that have helped you build your business know, you have to let them go. And so for us, it's always been about building a stable business, right, with a diversified client base, such that the investment management firm Stormfield Capital is durable and can continue investing over long periods of time.
yeah, and it's a. I mean, I commend you for it because you didn't face the same woes a lot of folks did during the crisis we had during COVID, right? I mean, shutdowns happened. A lot of folks couldn't continue to lend because they were overly reliant on what is now viewed as we kind of call it the secondary, right? They were overly reliant on that segment of the market, and some little chops aren't around today. Good, yeah. I mean, so let's take a look into kind of the lending style of Stormfield, because you guys, when we first met, I was under the impression that you were more of a CRE shop, and then I was happy that you did RTL, and to this day, you guys still keep a footprint in the CRE sector, right? The CRE bridge sector and those kind of loans. Was that always the case from the jump? Were you guys more multifamily when you started? Because you have a background in multifamily. Like, what was that like for you guys?
For me, kind of my background, as a multifamily investor, and just to be clear, I was very much a bootstrapped multifamily investor. So I was buying kind of 1 to 10 unit properties, with all my own, cash. I was doing, value add, not flipping, but just holding for kind of long term, income generation. So that was the asset class that I knew and is the one I liked. I mean, maybe just stepping back, right? Why invest in real estate? I think there are a lot of reasons, but I always appreciated, the entrepreneurial nature of real estate, right? If you're willing to be disciplined and work hard, you can affect the investment outcome. I think sometimes external market forces, well, obviously there's very clear interest rate sensitivity. Again, through perseverance, you can control the outcomes. When I learned about the asset class of bridge lending, right, real estate secured bridge lending, the aha moment for me was, oh my God, I can lend 50 cents on the dollar, generate a mid to high teens return against the same assets that I was working really hard to buy and manage. And it was just like, if you can do that, why wouldn't you do that all day long? Right. And so I think that was the initial premise. So that was a long-winded answer to ultimately say, we have always been residentially focused. So RTLs, fix and flip loans, small balance, multifamily. That said, right, the premise has always been, if you can find asymmetric, risk opportunities in the market, do those deals. And I think invariably, because there's a void of capital in the small balance commercial space, asymmetric risk opportunities, if you're disciplined, will present themselves.
Yeah.
And so, for example, we are not active, retail lenders, right? So if a sponsor wants to, buy a dated strip mall and they believe they can, renovate the units and increase occupancy on a Route 1 somewhere, we're probably not going to do that deal. but 4 or 5 times a year, a special situation triple net lease retail deal is going to fall into our lap because we are in that market where we can make a 60% loan to value loan with great credit sponsor, and they just need some transitional financing. So we'll support those assets when it makes sense.
Right. So it's not the primary driver for sure, right?
Not at all. I mean,
the small multi has always been something that's kind of been the small little brother of RTL, I guess you can call it, right? That's the 8 to 10 units, 7 to 10 unit, and it's coming back in a big way in our sector. Particularly, we're seeing a lot of headway, headway being made in the DSCR sector.
The way that I think about it is because some of this is also just following your clients, right?
Yeah.
And the path that you typically see. Fixing and flipping single family houses is a great way to generate short term, like a nice chunk of cash for the borrower, right? The fact of the matter is, like, oftentimes that's going to be taxed as ordinary income. And what we see is a lot of those folks over time, right? They graduate, right? Building long-term wealth in real estate isn't about fixing and flipping houses and making 30, 70, 100 grand per flip. It's about ultimately, right, buying cash flowing assets and holding them for long periods of time, right? That's how you get very well.
You're seeing the market evolve. Yeah. That's not, what was once auction house buyer, get it off the balance sheet in a week or two, right? Now is with a DSCR product, has been able to allow these folks to be able to invest in long term, which has been really nice for our lenders, both on the RTL side and the DSCR side. It's been really fruitful for them.
Yeah, and for the end borrower, right? Because
of course,
being able to hold on to those, right, cash generative assets and not have to sell them after they dump the value add. It's truly a win-win-win.
Right. I like to kind of ask you about the kind of mid-stage of the company as you guys are growing, because you started as a fund manager, you had your debt fund. Sounds like it's a relatively kind of similar to what we see out there, open-ended, Reg D kind of fund, high net worth investor driven as your starting point. But you made a transition to more of an institutional asset manager type role. Give us some color into that transition, because that couldn't have been easy. That's a very big lift for a lot of, it's a dream for a lot of our sponsors.
Yeah. No, I mean, it was, certainly a long process. It was what we had always sought out to do. And I can't take credit for this. My business partner, Tim Jackson, again, who came from the institutional asset allocators world, right? He had a vision that, we could institutionalize what is, right, ultimately a kind of, in the grand scheme of things, a relatively nascent asset class, right? With a very attractive, risk return profile. And, what we had observed was, right, there are a lot of really good investors in our business, right? The problem is oftentimes they would put a non-institutional wrapper around their business, right? And that's going to be everything from what's the fund structure, the fees, the terms on the fund, liquidity provisions, hiring a CFO that's a family member, right? All these little things that an institutional investment firm would never do. It's what ultimately holds people back, right? So when we set Stormfield up, we said, years 1 through 5, we might not be managing money for university endowments or charitable foundations. We need to continue building our audited track record, but we're going to set the fund up today such that ultimately we can do that. And then from there, it was just a matter of, right, putting our head down, doing the work, building the track record, and like we ultimately believed, right? It took 5 or 6 years of track record before you started getting looked and getting to a certain size, right? Because these institutions, they want to write $25 million checks. They never want to be more than 10% of the fund. And so you need to ultimately just get to a certain scale before you can get the looks.
But you've kind of proven the argument that it is feasible for a balance sheet lender to, in RTL particularly, to attract an institutional counterparty and be a balance sheet lender and maintain their same formula. Because what became sort of the expectation in the marketplace was, we can attract an institutional partner, but we're going to have to get used to either heavy leverage or selling a lot of paper to the secondary. And it might be a new secondary, it might be the upstream secondary, but we're going to have to get used to doing that. And you guys didn't have to do that.
We didn't. And, what I would say was, right, that temptation was there, right?
Yeah.
Because that temptation would have meant an acceleration of revenue generation in the
For
short
sure.
term. But again, we remained, we ultimately believed that, again, this is about, I always say like, the way you get, right, the way you get wealthy because think about our business, right? We're ultimately a fixed income alternative. I think when done well, yes, we are an alternative, right? We're a private credit alternative, but we're a fixed income alternative.
Oh yeah.
And you don't get wealthy in fixed income hitting home runs, right? It's about staying power. It's about building a durable business with a repeatable investment process. And you get wealthy doing that by generating exceptional returns for your investors over long periods of time. And so we've always kind of, when presented with all the opportunities, right? Sell loans, right? When you can make a 4, 5, 6 point rip on the loans, partner with a capital partner who will take down 95 or 98% of all the loans. As tempting as that would be, again, for reasons previously mentioned, we've never done it.
Right. And on the fund, you mentioned something earlier, and you and I have discussed this, on panels and other things, but you guys made a very intentional choice early on in the fund structure and design that not many sponsors do. I mean, it's becoming more common now. I feel like you had something to say about that a few years back, but it's one thing is, and as a securities attorney, one of the things I always see is early stage sponsors are trying to keep things on a very low budget because they know they're not going to be that profitable early stage. But I always warn them, like, that could be one of the worst decisions you can make. You guys went full bore, full audit, full fund admin, institutional grade structure early on. What was the driving force? Just you knew you were going to head there in a couple of years, or because you could have transitioned,
That's what it was. And we did over time increase the quality of our service providers.
Sure.
So, like, just for example, now Deloitte is our auditor, but we didn't start with Deloitte.
Right.
When we launched in October of 16, I think the first close was maybe $4-5 million. We couldn't afford Deloitte. So we had a lower cost service provider, but what we knew was that we needed, right, our financial statements audited. We knew that third party administration, right, that's table stakes, right? Yeah, we can do all the accounting ourselves if we wanted to, but an institutional investor wants to see that there's a third party calculating the books and records, every single month or quarter. So,
and someone they probably know as well. They have to make sure that they're an actual real administrator. That's an important facet too.
That's too. No, I think what's great, and we've obviously had the opportunity to speak with some of these folks on at some of your conferences and some of the panels. I think what's really nice to see is that service providers have found our industry, and I think today versus 10 or 12 years ago when I started out, when there weren't very many service providers in that kind of low to kind of mid-tier range that could help an emerging fund get off the ground. And so just one nice benefit of our industry coming of age is that, right, the population of service providers has just gotten much more
and much more advanced too. I mean, the interesting part is the big shops are also making their headway into our sector, and Deloitte's a good example, right? Deloitte, KPMG, they're now creating programs that are designed to fit what I would consider a middle market player, not necessarily an emerging player, but a middle market player. Can be a good fit for those kind of shops now, thanks to a couple different changes they've made to their service profiles. Let's talk about the kind of growth of the fund real quick, because one of the things that you mentioned earlier, you got to the 5-year-ish life cycle. Was there anything else besides the audit, the admin, obviously the quality of the sponsor, the quality of loans? That goes without saying. I think the audience can understand. Was there anything else besides, was there any kind of key events that allowed that fund to really oh, now we're cooking with gas, right? Was there something that happened in the during those 5 years or after those 5 years?
One of our fundamental, right? And this is us, right? This is ultimately us, being very deliberate about how to best attack this asset class. And it's nothing more than an opinion. Um, but we don't believe that using structural leverage on these types of loans is ultimately good for the investor. Right? We are able to generate, right, net of fees, high single, low double digit unlevered returns in this asset class. Now, if you put a turn or a turn of and a half of leverage on a portfolio of these loans, you can get that up to 13 to 15%, net of fees. But what I think is oftentimes missed is what happens not only to the investment performance, but what happens to the platform when the tide goes out.
Yeah.
And, we saw that, very clearly, with COVID. Obviously, securitization stopped, but you also saw, and I'm sure you consulted with many clients on this, right? Like banks pulled out of the warehouse business, the leverage dried up. And now all of a sudden, you as an investor are forced to generate liquidity at the absolute worst time. So you're selling loans, maybe performing loans at a discount just to pay back your senior lender. And, again, it's that same type of issue, right? The leverage works when it works, but when it doesn't, it's really bad. And so
So
this is
it's back to the idea of independence for you guys then.
exactly. It's back to this idea of independence. And to answer your question directly, when those type of market events happen and Stormfield is still sitting there, right, unlevered, ready to continue to lend, right? That's when we not only gain market share on the kind of the origination side of the business, but then our investors, I think what they see, wow, right? We are in this, very volatile time. Stormfield is still performing, right? And then they, will either make net new investments, will bring on new investors. And so we've been, in a lot of ways, our biggest periods of growth in terms of production, the loan production, and assets under management growth have been in periods of market dislocations.
So then that raises an interesting question: is like right now we're kind of in this weird stage in life cycle where leverage is quite common. So not just funds, right? I mean, I would say the vast majority of debt funds in private lending have some leverage, right? Moderate to moderate meaning kind of sub 50% of the portfolio value of the equity, to as high as a straight 1-to-1 ratio. Now then you all add in the layering of securitization. Right now securitization is becoming quite common, and it was once a thing that only companies like Turac could do, is now being democratized to your local lender. And so now we're seeing an interesting phenomena, and that's all leverage, right? For the uninitiated, securitization is a very really fancy version of leverage, right? And so now we're in this phenomena of the market being quite akin and quite accustomed to various forms of structured finance, right? But that creates an interesting phenomenon for you, right? Because now you're having to keep up, compete. What would be your response to that kind of change in market condition? Because your competitors that are of a similar size or smaller are now pursuing securitization, right? And so and they also have lines of credit, and because now the asset manager doing the lines of credit and it becoming quite leverage is becoming quite robustly offered. What is your response in that situation to maintain competitive edge?
Yeah, I mean, ultimately, if we get to, and this happened, right? This happened for us in 2019. I think it was 19, securitization, certainly not at their kind of 2021 peaks, but securitization was firing. And, we got to the point where your standard RTL was going out at, 75 LTARV, 95% loan to cost. The level of diligence on sponsor experience was just getting like weaker and weaker. And we stopped making fix and flip loans. We said, we're not going to play that game because it just doesn't make sense anymore. And that's where the ability to transition between, lending strategies, is really valuable, right? So I think at that point, where we just basically said, look, we're not doing any RTLs unless we can be at sub 65 LTARV, 85 LTC with, local experience that we can verify. And, we made value add multifamily loans, right? Which turned out to be, a good period to do that in, quite frankly. So I think that's really it. Now, we, think about today's market, right? Where are we today, right? I think it's a really interesting time for RTL securitization. I mean, the fact that we've gotten rated deals done, I think is a great thing, broadly for our asset class.
Oh,
I
sure.
think it's a great thing for, the super majority of market participants. But I would say this, I would ultimately just ask the question for the end investor, right? The end investor in the bonds, what are you getting for all of that market structure? And I'd leave the question there, right? Because I think what I know definitively is securitization is very good for the investment manager, right? I can securitize, whatever. I can do a $200 million securitization, hold a reasonably small kind of equity piece, right? Get a very high amount of leverage. Everyone gets paid. I guess my question for the investor is, are you being adequately compensated for the risk? So all that market structure, none of it's cheap, right? The lawyers are making money, the AMCs are making money, all the third parties who are testing the appraisals after the appraisals are done, everyone's making money. Everyone's chipping away at the economics of that pool of loans. And that's what we're talking about. We're talking about a pool of loans. And you securitize, you're just introducing a lot of service providers who are chipping away at all those economics. And my ultimate question is, end investor, what are you getting for that?
A bond investor is making a straight note rate, if you think about it, right? And it's sliced into dice at least into two tranches.
Yeah.
So
and I think for the investors, for the lenders, who are listening to this podcast, we know where the risk is, right? These returns that we generate, it's not free. We know where the risk is. We know where the level, we know where the leverage levels are, and we know what's going on under the hood. And again, a question for Mr. Bond investor, right, who's buying in, whether you're buying in the A1 or kind of A2, are you being compensated adequately for the risk in the portfolio, or is the premium being eroded by the service providers to create this market structure? I think I don't know the answer. Maybe I'm leading a little bit here. Maybe I have an opinion, but I think it's something that should be looked at, quite frankly.
You have some valid points in the context of the return profile is not very high compared to what a balance sheet can produce, right? If you think really just distill it down to its core structure, a balance sheet could easily produce a much higher coupon. What I've been told, and this may not be true, but I've been told is that there's a lot of what I would call bells and whistles added to the way this thing is run that give the institutional investors, the pension plan investor, right? Basically, those are the core investors, right? It gives them comfort, I guess you can say, right? And all those service providers are the reason why they get comfortable, I guess, right? And so that goes back to the question mark for them is like, well, why can't you guys get comfortable downstream? Because really, who better than to manage this portfolio than someone like yourself, right?
And that would be, clearly, I mean, that's clearly my view, right? That's also me talking my own book, frankly.
Well, sure. You're self-interested but at the same time, as an industry rep, I don't disagree, right? I think that there should be. I've always racked my head around the pension plans have always had a very big hurdle to breaking into the direct kind of main street level the actual sponsors. There's always been a massive disconnect there, and we don't see the same level of disconnect in other forms of credit, right? In commercial real estate, even we don't see the same level of disconnect between the life codes and the pensions and the direct lenders. What is it about our industry on RTL or DSCR or construction that is keeping them from going direct to the sponsor? Very interesting question, because there are several that I would say meet the what I would call institutional grade type programs, right? It's an interesting question. There's no answer for it. I don't know that there's an answer for it.
I think, look, I do believe that, right? And again, it's interesting to study, right? It's interesting to study, like you study the securitization markets and why did securitization begin 50, 60 years ago, right? They were ultimately looking to generate liquidity for loans that backed veterans' homes, right? That's why the first securitization got done. And so, you fast forward to today, right? You are bringing liquidity into this market, which is helping to, right, transform dated housing stock for, today's population. So I think in many ways you are, right, you're doing very much of the same thing that the market structure originally set out to do. Um, I think there are some differences though that I think just investors need to need to be aware of. I'm not passing judgment,
Right.
but right, I think it comes down to right, what's unique about our business, right, the RTL business, and again, I give a lot of credit to John Beecham at Turac, who I think conquered a lot of these issues that the end bond investor had with the short-term nature of the loans and the need to kind of reinvest the portfolio,
Right.
given how liquid these pools are. But I think that's where the rubber meets the road, right? Like that short-term nature of the loan makes it a challenging product to securitize. And look, it's been done.
100%. But at the same time, this is not a new thing. Like this, what the funny part is, like, commercial bridge had its era of CLOs. They still do some CLOs. It had its era of CLO activity.
Yep.
Non-QM. It's longer term product, granted, mind you, but still they have their residential. They had their own. They're still doing a lot of securitization in that sector. What's strange is that at least in commercial real estate, it transitioned. It felt like, where the life cos, particularly pensions, never made a move down, but the life cos made a move downstream.
Yep.
And the asset managers made a move downstream, direct to the street.
Yep.
Because they realized, wait a minute, I don't need to do all that. I can just fund it on the balance sheet. And so I'm hoping that our space takes an idea from that market, not necessarily the non-QM market, because there's just too many starts and stops in that sector. I mean, the amount of layoffs that we've seen in non-QM is mind-blowing.
Crazy.
I think crazy.
I think and groups are obviously doing it, right? Many of these large asset managers and their kind of captive insurance businesses are kind of already in our space in various forms. But I do think, right?
I think they're more concentrated on DSCR, to be honest with you, though.
I think that's right.
Yeah,
that's what
they haven't wrapped their head around the short-term nature of the RTL product, at least for the balance sheet.
Yep.
Yeah.
Yep.
They're real uncomfortable with it still, it feels like.
Yeah, I think there'll be some, right. There'll probably be some interesting. I think they'll take the form more of, right, separately managed accounts, right? I think that's the way, right? Because of the constraints that insurance companies have in terms of.
And there are aggregators that do that, right? And so my question is always going to be, when do these guys get comfortable coming down to the actual originator and being? I'm not asking for them to be a fund LP, but I am asking, like, you guys should really give the actual asset manager the shot, the actual originator the shot, because if they've got the track record and they've got the servicing book, they're a better asset manager than you think. I think that's the question. They don't think as highly as of a direct lender as compared to some guy that has, 5 years on the street,
Yeah.
And
it's a great point. And I think what's interesting, and I'm sure you've observed this, but right, you're starting to see the pricing disparity in self-originated deals. So securitizations that are originated by the issuer versus unrated or rated, right? Basically aggregated deals, right?
Yeah.
And so I think the market is starting to realize that there is value in the issuer being an originator. And I think the market over time will continue to give, right, a better bid on the A1 for investors who are both originators and asset managers.
I tend to agree. I think that's going to be the future trend of securitization, is that you're going to see a lot more direct. Like, it's going to have to be, Chiavi basically established that for everybody, but even the smaller shops that they're going to all end up doing. I mean, there's so many right now that are gearing up for one. And so when Rain City did their first deal, that was kind of the big gong for everyone. Like, okay, this is feasible for a direct lender. It's not just for the big shops, not just for the Wall Street types to do, which is great. I mean, I give kudos to the bankers that can, bring this downstream to our larger shops, and hopefully this becomes something where it's not so complicated for everybody to do. But at the same time, I see your point. Like, if you can do it without leverage, and you can do it without all of that, and you can do a good job, and you have the capital resources to do it, why wouldn't you? So,
right.
And this has been a nice discussion on capital markets, right? And where we're headed. But, one of the things that I like to ask you is, does that push you now into more, or at least the time being, into much more commercial style assets, right? Because I'm seeing a lot of opportunity in that sector, right? We just had our conference last week, and one of the discussion points is that it seems like commercial is back, at least in multifamily and some, triple net lease, a little bit of industrial. They're making its way back. Is that going to be something more you guys concentrate on for the time being?
We're committed to residential lending. And just because, right, there's more liquidity chasing, RTLs, right, we're still going to find pockets of opportunity. If we have to, right, find those deals that make sense and earn a little bit less on them, we're going to do that, right? We're not going to push the risk level to kind of keep our returns, propped up, right? We have a very targeted kind of risk level that we're looking to maintain. Now you could, like, as I said earlier, right, you could get to a point where so much, capital flows into the space that you just have to ultimately say, like, look, I'm not going to do a 80 LT ARV, 95% LTC deal. Like, I might as well just do the equity if I'm not.
Well, we're hearing complaints of similar effect, right? And so, I'm not going to name names, but like a lot of our sponsors that we meet, especially when we're on the street at conferences, like they'll tell us, like, man, I just can't compete with these guys. They're killing me.
Yeah.
We're seeing a lot in California, at least. And so, I mean, you guys on the East Coast have been luckier with there's not been as much rate compression out where y'all are.
No,
for sure.
No, we have the benefit of judicial foreclosure,
which makes it more expensive to operate, for sure.
Yeah. So you need to be. I think it keeps a lot of the West Coast capital, at bay, and doesn't kind of flood in as much. But
right. And for our audience, give the idea what are your kind of core markets for Stormfield?
Yeah, about 35% of our book is in greater New York City. Do a lot of lending in Connecticut, Massachusetts. 15% of the book in Connecticut, 15% in Massachusetts, and then we really kind of lend down the eastern seaboard, kind of Carolinas through Florida. Just interesting kind of current market observation. At one point we had as much as 28% of our portfolio in Florida. We've trimmed that back to 14% as of today.
Is that because of the insurance issues, the fraud, or all the?
It's predominantly, like, I think there's two. Hurricanes led to the insurance, and then I also just think, right, you have this unwinding of not everyone who moved down to Florida during COVID is going to stay there kind of long term, right? You've had
North Florida seeing a little bit of an exodus,
return to office, and so I think Florida. I mean, you look at the west coast of Florida. Some markets are down 10-12%, year over year. I think they probably have some more to give, quite frankly.
It was starting to get a little crowded down in Florida too. I feel like everyone was lending down there.
It is, yeah. I mean, like, Texas and Florida became so crowded. But
at one point, we noticed that the rates in nice major metros in Florida and Texas were lower than California.
Really?
It was fascinating. Yeah, we were like about 50 basis points higher than Austin and Dallas and San Antonio. It was fascinating.
Yeah, I've never seen that data, but like anecdotally, it doesn't surprise me. We'd made some pushes into Texas, call it 2022, 2023, and put out some good loans, but very quickly we saw that again there's just so much competition, and we certainly didn't want to chase in a market that wasn't we didn't know really well.
Right. And I want to kind of ask now, you said you coined the phrase before we started the pod, but you've taken quite the contrarian position to the market. Like, there's not a fund manager out there that looks like you guys. I know one very similar to you guys. They're pure balance sheet, no leverage. Like, they don't manage assets for institutions, but they're multiple funds, but they have a very similar philosophy and their lending criteria. But they're the only one that looks like they're here on the West Coast. So you might have a twin out west, but most of your colleagues and competitors that look like you have not taken the tack that you have. And so I like to kind of expand on that a little more. Like, what's driving that contrarian? Is it just confidence in what you're doing, or what is that? Because you had to have been approached by several providers out there.
Yeah, I mean, look, we've been approached by everyone looking to buy our loans, buy our management company,
Yeah.
set up JVs. One of the things that someone, when I was a younger man starting in this business, someone at one point said to me, he's like, you just could, keep producing good loans, and eventually you're going to have more capital than you know what to do with. And I think that is ultimately come true, right? I mean, we've produced, nearly 2,000 individual loans since inception. Our performance and track record is very good. I'll leave it there. And ultimately, right, I mean, there's infinite capital that we could take in for this strategy. Now, if we were to take in, like we manage $750 million now. If someone tried to drop $500 million on us, we couldn't deploy that capital, right? Given the turnover of the portfolio, we couldn't deploy that capital. It would take us a year to deploy an incremental $500 million.
Because you're not considering to change the strategy then. The strategy remains the same.
The strategy remains the same. And like, there's always growth and there's transformation on the margin, right? But I ultimately think that, right, keep it simple, right? Do what you're good at, don't get distracted, right? These are some of the principles that I think have ultimately kind of, guided us as an organization, right? And that's everything from, hey, you have all these fix and flip borrowers. Why don't you start selling DSCR product?
Yeah, I was going to ask you, but it's not. DSCR is not a thing you guys do very often.
No,
right?
and I think for us, like, it may seem like we're leaving money on the table, but right, I have limited resources. I have limited time. Do I want my resources focused on effectively brokering a loan to make a couple points? Or do I want my resources focusing on originating the best short-term RTL or commercial bridge loan that I can hold on my balance sheet for my investors who are going to, stay with us for 7, 10, 15, 20 years, right? And so it's all about, in my mind, it ultimately comes down to, you have limited resources. And are you trying to build a cash flow for 1 to 2 years, or are you trying to build a cash flow for 10 to 20 years? And we just try to systematically make the decision that builds the cash flow for longer periods of time.
So there is that level of like, we've gotten here successfully by sticking to our guns, and our investors, you're thinking about your investors as the driving factor behind it, because they're the ones that you're thinking about their perspective on this. You don't want to disappoint them, it sounds like, or you don't want them to feel like you're changing too much.
As a fund manager, you answer to your investors, right? And as much as you have a lot of flexibility out in the market, right? You're out making loans, and in the end, right, the business is only as viable as long as your investors who kind of trust you and have confidence in you. And yeah, while it would be great to broker $100 million of DSCR and rip whatever 3-4 points off that, that would be generate a nice amount of revenue for Stormfield as a business. Again, I'd rather build a durable cash flow stream over a longer period of time, and we do that by focusing on investing our investors' dollars to the best of our ability.
We've seen a lot of our sponsors now do deals with various, I would call private equity firms or these, large institutional asset managers, but you're working particularly with endowments and charities, and it's a very unique institutional caliber investor, because it's not something that you ordinarily hear about. What was it about that kind of community of investors that drove you? Was it just the access points that you had to your partnerships, or was it something you intentionally followed?
Yeah, I think we were fortunate, and a lot of credit goes to my business partner Tim Jackson, who had entry into some of these organizations.
I see,
because oftentimes you're just not gonna get a look.
Right.
Now,
he knows how they operate, and he knows who they are.
That's right. And there's another piece to it too, quite frankly, which is, for those that may not be aware, right? Most of these institutional asset allocators, many of them will make their investment decisions in-house. Many of them use consultants. And a consultant is essentially, right, a third party firm that will do due diligence on investment managers and investment opportunities. And only after a consultant approves a manager will the endowment or foundation be able to invest with that, right? It's basically an outsourced kind of due diligence type of organization. There are, right, and while many endowments will use consultants and pensions will use consultants, there are some more entrepreneurial endowments who are willing to look at, quote unquote, emerging managers. And I think the definition of emerging, it's not a $15 million fund, right? An emerging manager for an endowment is probably $100 million or
right. Back to that 10%
$200
issue, right? They're not going to want to have more than 10%. So
exactly. So I think we were lucky in that, Tim had some good access into that channel through his prior roles. And then we were fortunate in that we came across some entrepreneurial chief investment officers who were willing to take the time to understand and explore our asset class and understand the risk return dynamics.
Do you feel like that part of the institutional investor world will start to kind of wake up to the sector a lot more aggressively? Because we've seen, if you look at the kind of Wall Street type investor, they are just now on fire for this asset class, particularly because of the securitization and the ratings. Do you see any kind of headway, opportunities for them to get more active? Because life cos are starting to make their ways in. We're seeing the institutions up in their own shingle or buy an originator and set up an originator. We haven't seen it from like that side of the institutional world, nor the pensions really either.
Yeah. I think one of the challenges is, I alluded to this, and I think our audience will appreciate this. What's unique about our business is, while, we're originators, we're asset managers, but, we are running we're running operating businesses here.
Correct.
Right? We're not just picking stocks and picking bonds with a thesis and a kind of a risk overlay. We can't go out and buy an infinite amount of these loans, right? We are running operating real estate businesses, right? There's a loan servicer, there's an originator, there's an asset
underwriting.
Manager. They all have to work together. And I think what happens oftentimes is many of these institutional asset allocators, when they come in and they realize that this isn't just a investment business, right? There is an operating element to investing in this asset class. Quite frankly, a lot of them get, I don't want to say scared, but sometimes they don't want to do the work, right? There's a lot that goes into, right? We haven't talked about servicing, right? But servicing a portfolio of these loans, right? There's a lot that goes into it. And sometimes they just don't want to do the work. So to answer your question, do I think there will be continued interest from these institutional investors? Absolutely. We're seeing it in real time. How durable will it be? And, will it get past those kind of entrepreneurial chief investment officers? I think that's the question.
All right. Well, it just kind of begs the question. It's the endowment world, particularly, and the charitable world, has always been kind of like, you don't hear a lot of activity in our sector from those guys very often. And you're really the only organization that I know that's really kind of made it through, right? And so it's just fascinating that, well, in my brain, like, well, when loan buyers first became a thing back in 2014, 2012, that was the kind of the impetus for a lot of the institutions to start, slowly coming in. And my question is now is what Wes is doing with these guys going to be a way for them to come into our sector on that side of the house? Because they don't buy loans. You don't hear a lot of things about those types of investors. So it's, here's hoping, right? Because it's a much better type of investor, it sounds like.
Yeah, look, they are, but here's the other thing I would say, and right, it's always there is always this kind of grass is always greener effect, right? And so to the fund managers who have a portfolio of high net worth investors, who are writing $100,000 to $200,000 checks, and like, oh man, I just want to, I want a whale, I want a $20 million check. It's interesting to think through, right, who your end investor is and what role you're serving for that end investor, and what option of suite of options do they have to invest in. So like the old adage has always been that, right, when you get a university endowment or a charitable foundation, right, they do a ton of upfront due diligence. I mean, these processes can take upwards of 18 months from like a first meeting to investment, right? So it's not quick, it's not easy, it's a lot of work. Now, the old adage was always, yeah, it's a lot of work, but once you win that investment, they're going to be with you for a long period of time. What I will say is, remember, right, these are highly dynamic, right, by definition, entrepreneurial endowments. And for example, right, if our asset class, right, if we see rates compress by 100, 150 basis points, we might not be interesting anymore. And that endowment has the ability to dynamically rotate into another strategy where they can pick up another 100 or 200 basis points, right? We have to remember that this asset class, right, whether it's RTL or commercial bridge, right, it exists within a very broad suite of alternative credit products that
Yeah.
these endowments can invest in.
And there's increasingly high yield on the other side of the world. Not necessarily our real estate, but
exactly. And so I think there is more, there's a greater risk than I think people appreciate that these endowments, right, as great as like the big check sound, they're also, right, constantly testing you against other asset classes, and they can redeem, right? So kind of money takes a long time to get in, and they can pull it out, they can pull it out pretty quickly, which is right. Juxtapose that to your high net worth investor, right? You're serving a critical role in their portfolio by generating stable, high yield that's going to allow them to retire, right? And as long as, I don't know what the number is, right? As long as you're printing an 8.5 to a 10.5, you're probably not going to get fired. And so there's value to that client type.
I don't want to deny the fact that the high net worth investor is still one of the most important type of investors out there for a fund manager. I mean, it's for a debt fund manager in our space, particularly, that they are the lifeblood of the balance sheet lender's life cycle. That you can't deny that for sure. One of the things I wanted to kind of get your thoughts on is, we touched on this a little bit earlier with the advent of securitization, the democratization of securitization. But the market's headed in a weird place. We're in a weird time right now. I mean, that's been the truth since the beginning of, since APL last November, right? I mean, everyone's been very cautious. Everyone's been kind of concerned. I don't know the sentiment has really changed since then. Now we're in August 2025. We're about to go into the next APL for this year. I don't know, what are your thoughts on where we're headed and what we're seeing out there? Because I really am having a tough time with my finger on it, because to me, it feels like there's some shops that are just killing it out there, and then there's other ones that are really struggling. And it doesn't matter on the profile. There's a lot of people that are struggling, and a lot of people that are winning in the same product.
Yeah,
in the same market sometimes, which is really strange.
Yeah, no, it's interesting. I think your characterization of the market is just spot on. It's a weird time. It's a weird time to be an investor. It's particularly a weird time to be a real estate investor.
I mean, they're the ultimate client, right? So they have to be feeling confident for our clients to be doing well.
That's it. I'll say this. What I see in the market, I think there is in multifamily, I think the market is hitting its trough, for lack of a better term. I think you are starting to see product move through the market, right?
Mm-hmm.
So whether it's
very true.
Yeah. So like product is working through like, cap rate expansion wiped out the equity in a deal, and the equity manager, fought for an extra 18 to 24 months, but now their fund is coming to an end and they need to sell the asset. And right, that just gives, the next sponsor an opportunity to kind of reset their basis. And I think that's good, right? That's healthy. That's what the market needs given where rates are today. So I think, I don't think multifamily, like if I were an equity investor, I'm probably not necessarily, if I'm trying to time the market, I'm not necessarily buying the market today, but I think we're in the trough, like somewhere near the bottom of the trough. And just given like what we've seen with starts, I think, you're going to start to see, rental growth pick up again. Occupancy's been pretty good. So, I like multifamily over the next, call it 2 to 5 years.
Yep.
I think.
Let me ask you a follow on that. The lack of agency permanent financing, though, it hasn't been solved yet. They're not back to the table by any means. Now, banks are now making some efforts to kind of fill a little bit of that gap. But I don't see any kind of, I mean, we're not seeing any kind of like DSCR like product for the bigger multifamily deals. So I mean, that's my concern is permanent financing is still kind of missing.
Yeah, no, I think you're right. I think that's going to be a challenge that the market needs to figure out. And, that's where you hope you hope some of the, whether it's insurance money, some insurance money coming in could be helpful, right? I mean, like, I think what we know is that the private markets, in various durations, right? It's not the permanent kind of agency solution, but in the short term, the private markets have stepped in and have helped to solve this issue. I saw some stat where I think like as much as 50% of the kind of short-term CRE deals are getting done by kind of private lenders, up from about 25 or 30% a few years back. So I think that will need to be worked out, and a very, very real risk to the market. I'd say the residential markets, right, have their own challenges, right? It over the past, I mean, look, how long has it been, right? The period since COVID is it the period since the kind of, GFC in 2012? But, right, there's been a very nice structural tailwind to residential for a fair period of time now. You're starting to see cracks, right? You're starting to see really what is a tale of two cities across the United States, right? You have areas in the Northeast and pockets of California where prices are, this is single family real estate prices are stable to up 8%.
Oh, yeah.
Juxtapose that.
Orange County has been blessed with that feature for a long time. It's fascinating.
Yep. But then juxtapose that to Austin and Tampa and, right, the Sun Belt, right, which, ultimately just got overbought post-COVID. And now you're starting to see, softness there. So I think as a residential investor, whether you're on the debt or equity side, I think our job it's a little harder, right? You need to kind of get back to first principles and bottoms up underwriting. You can't just rely on, hey, I can lend against anything in Florida because, right, property values are increasing 7% year over year, every year, and that's going to bail me out. You need to be more tactical and more dynamic, and again, focus on fundamental underwriting.
Yeah, I tend to agree. I mean, disciplined shops are seeming to be the winners in the long term, but the challenging thing for the disciplined lenders is always going to be, man, that shop out there is, killing me on price or killing me on leverage, and it's the reality. You just got our market's grown up, so you're going to have that no matter what you do.
Well, it's funny too, right? Because like, let's talk about Kiavi, right? Because I think Kiavi is, in my mind, such an, they've done so many impressive things, and so many peers, in the RTL business who are like, oh, I can't compete with Kiavi,
I hear it all the time.
I can't compete with Kiavi. If you actually look at Kiavi's pricing, I don't think Kiavi is winning on. I don't think they're winning on pricing. I think they're winning on customer experience. Quite frankly, I think they're winning on technology and customer experience. Kiavi charges 1.5 points, right? So like when you tell me you're losing on price, Kiavi's charging 1.5 points. And if you look at their rates, obviously, I think they do a great job at giving the investor, the borrower, the ability to, right, dynamically like size their leverage, kind of buy down their rate, I don't know if they can buy down their points, but I actually, I don't buy into the narrative that a group like Kiavi is. I don't think they're winning just because they're securitizing. I think they're winning because they have invested in technology and they've invested in customer experience, and they're doing it better than anyone today. And that's a simple fact.
Sure, you on the platform is a very, very nice platform. It's very easy to operate under. If you're a borrower, it's just night and day compared to your average loan officer's experience. So I think you got a valid point there. And I'm just relaying, from my perspective, I'm relaying the complaints that I get out there. But this is something that hasn't been discussed more, and I think does need to be discussed. We used to talk about this all the time during the early stages of the industry. How do I create that Amazon buy with one click button? How do I make, and that kind of sentiment's really been lost. I think that has more to do because of the intricacy of the market. We have all these different players involved, and now it's not just with your shop, it's just you guys are the lender, right? It's not just that anymore. So you see kind of similar, shades of non-QM, like, oh, my investor is doing this and I have to do this and I have to deal with that, credit matrix, and that's changing, and my line of credit over here. And so, that seems to be causing, we call it slowdown on the borrower experience side, less of a focus on it too.
Yeah. Well, I think at least what I've observed, and I'm curious as to your perspective, is too much of the technological investment has been on what I would call, right, the platform side. And so, right, everyone's trying to put a tech wrapper on our, I don't want to say it's not a very simple business at all. It's the contrary. It's extremely complex and intricate. But by focusing on whether it's like the peer-to-peer model or like the AI underwriting kind of model, the AI aggregation and diligence model, right? Like these have invariably failed, right? They raise VC capital because they're putting a tech wrapper on a lending business. They buy market share. They then realize they need to do something with these loans. And so they start selling them to whole loan buyers.
Yeah.
And then the platforms go bankrupt. And right, I mean,
you can't run a capital, you can't technologify capital raising.
Exactly.
As I've always,
exactly.
You can't. A robot can't replace, especially in our high net worth investor driven community, a robot can't replace you. No. Yeah, it's not possible.
But what I think, right, what Kiavi is doing right is Kiavi is using their investments in technology to empower the borrower. Yeah. Right? They're giving tools to their borrower to go out.
It's online shopping. Make it online shopping.
Invest with confidence, right? I want to know that if I make an offer on this property and it gets accepted, I want to know that I have a lender that will do the deal. I want to know what my equity check is, and and it might be 9:30 at night, and I want to feel like I'm making progress on my loan, so I can upload a few docs to a portal. That's the value.
Yeah, I feel like the nice part today is that people kind of like realize that, wait a minute, like that's the only version of technological advancement in our sector that's at least on the sponsor side. Right now, granted, there's a ton of different technological solutions on the vendor side, and they all have their own virtues, right? LOS platforms, Lightning Docs, and competitors, like they all have their own virtues. But on the sponsor side, you're 100% right. I on the capital side, the whole platform world, the P2P, crowdfunding, fintech for a while, like unless there's no unless. The biggest names in fintech and real estate finance still have people component to them no matter what they do. You cannot replace the people. It's just making it a little bit easier to raise the money, but at the end of the day, you're still having to answer to your investor. Now the borrower, but e-commerce has proven like you can eliminate the human component in how you take a loan application. You still need loan officers. You still need people inside to actually answer questions. But like, the eliminating the need, but then at the same time, it's like, every company, no matter how big they are, is always going to want to fill the bucket more. And so they're going to end up down the path of wholesale or correspondent. They're going to have to add those features, right? There are always companies like that. Many companies are fighting the urge to do it, but the large shops, I think they're going to have to, no matter what they do, no matter how much they tell the world that they're, borrower facing only, like they're, by virtue of the need to fill the capital markets demands, they're just going to have to continue to originate more loans, and that means wholesale at some point.
Yep.
So that removes them from technology faster.
Yep.
Right. So there's two posts. I mean, you see the same thing in consumer, right? And Rocket, their platform is amazing, right? So I think you're right. The borrower experience is probably something that we should all be thinking about from how do I make this better, basically. Whether you use technology or not, I don't necessarily know that technology is the end all be all. But it certainly is more affordable for the borrower if the company doesn't have that giant overhead of people. So
yeah. No, it's the you get the call from the the mortgage broker, the borrower, and they say, "Wow, you picked up the phone. That's great, right? How many? I called 4 lenders, but none of them picked up the phone. Sometimes it's just back to picking up the phone, So
back to fundamentals. And there are a lot of shops, many that we kind of look up to you guys, and so companies that look like you guys on the West Coast too, like. Their philosophy hasn't changed. We're customer service oriented, and that's how we're going to win. So we're going to be Kiavi is kind of their MO, which is fine too. I think it works.
Yep.
With the right kind of loan, right? On the right kind of loan. Because at the end of the day, I think RTL has become quite commoditized. I think you're right on that side. On that side of the house, I think you're right. Cool. Well, I think that's about all the time we have for this episode. Wes, I love talking to you, man. Thank you so much for coming on the show.
It's my pleasure. And maybe just very quickly before we wrap, I need to just
get off your chest. Let's do it. Yeah.
I don't know how you probably don't know how important this moment was for us, but this is probably 2017. I remember the moment vividly. We'd had success in raising capital. We were originally a C3-1.
3C1. Yeah.
And we'd been successful in raising capital, and I think we had 79 investors in the fund, and we can only have 99 investors in the fund. We're C3-1. I was in Boise, Idaho, in a hotel room. We had a call scheduled, you and I. And, I got you on the phone and I was like, oh my God, what are we going to do? We have these 12 investors who want to come in. I went into this deep diatribe on like, oh, well, my reading is that we can, we don't have to count these investors and they collapse these investors. And so maybe we can get the slots in. And you're like, Wes, have you heard of a C3-5? And, your advice ultimately allowed us to, we kind of restructure the registration, I guess you would say.
Yeah.
And it opened us up to, the path that we've ultimately been on since then. But, I'll never forget that conversation. I'll never forget the advice that you gave and kind of the path and opportunity that opened up for us. So I'm eternally grateful for that.
Oh, you're too kind, man. It was just doing my duty, sir. That's all it is. I mean, I really appreciate it because we're struggling out there too, right? We're kind of trying to win more business, and I appreciate the kind words. It's really hard for us to get those kind of opportunities, and you gave us one, so I really appreciate it.
Well, thanks again for the opportunity, Kevin.
Oh, of course, man. This is a really good one. I really enjoy these kinds of conversations because your headspace is different than a lot of our guests, and that it's important that our listeners hear a different perspective. And I'm really glad you gave it today. So for everyone listening, thank you for listening to Lender Lounge with Kevin Kim. This was an episode with Stormfield Capital and Wes. Wes, once again, thank you so much for joining us today. This is Kevin Kim signing off. Subscribe to Lender Lounge on your favorite podcast platform and visit our website, fortralaw.com, to learn more about how we can help you scale.